Thank you guys again for staying here for a little bit of our technical delay. Want to kick it off and let you know kind of throughout this, please feel free to drop any questions in the Q&A as we go along, and we will try to answer them as we go through. If not, we'll save them for the end if we're not going to, cover them within the deck. And yeah, again, drop those in the Q&A, not in the chat. I won't see them if they're in the chat. And that being said, we'll go ahead and get started. Okay. So just a little bit about what we'll cover today is we're going to talk about who we are, a little bit about myself, a little bit about Chris, our backstories getting into this space and the launch of the fund. We'll also talk about the market opportunity and mortgage notes space. We'll talk about what mortgage notes are and how we make money when investing in mortgage notes. We'll talk about our whole fix and flip model and what that can look like as a passive income play. And we will go from there. Okay. So kind of to kick it off again, now that I found my bearing, thank you again. My name is Lauren Wells. I'm here today with my co-founder, Chris, and we are Seveney Investments. We are a real estate investment company focused on buying and selling mortgage notes that are secured by single family homes throughout the US. We've been doing this for just under a decade and have had, this is not our first rodeo. We like to say we invest in mortgage notes and we fix and flip them. And I'll talk and break down that fix and flip kind of model later today. Also, I don't know if anybody on here, I feel like I just need to give a quick shout out to anyone who was at the Invest Her conference last week. I'm sorry I didn't get to see you. I was really bummed I couldn't be there, but I'm sure Tony and Katrina held down the fort well. So if you were from there and you are joining us today, thank you so much for joining us. So a little bit about our backstory. Chris, I'll let you go first since I feel like I've done a majority of the talking up until this point.
Well, thank you, Lauren. And part of our backstory is very unique because Lauren and I come from two different backgrounds. I'm on the East Coast, Lauren on the West Coast. I've been in real estate since the 90s. And I was the type of person growing up who would work 60 hours a week and have my personal life, including my personal financial status, completely devoted to my W-2. And about 10 plus years ago, I realized when my parents were starting to retire and didn't have adequate reserves for retirement, it hit me that you needed to have something outside of a 401k and other type of investment product. So I started investing in mortgage notes. I started just buying several notes and quickly grew. And over time, after doing several funds, I realized kind of three things. One is I definitely need a business partner. And that's where Lauren comes into play. And the other two were they were both accredited, but also a lot of non-accredited investors who were interested in mortgage notes and were interested in income play. And that's where we are, finished today with our Regulation A+ offering that we will talk about a little more. And I will let Lauren share her story.
Awesome. Thank you. So it's similar but different. I started out in the W-2 world, but I also volunteer coached a local high school sport. And while I was doing that, I think my aha moment was when I realized that most of the parents who were there, I was not a mom at the time yet, but I did know I wanted to become a mom, were either business owners or invested in real estate. So at that point, I decided to learn as much as I could about different ways to invest, whether that was, and I kind of went through all the things. I looked at, buy and hold, flipping, short-term rentals, wholesaling, and stumbled across mortgage notes. And at the time, I was also working in software sales for a startup here in California. And what I did was I was using my sales income to subsidize my investments and built a portfolio in mortgage notes. Couple of conferences and networking events later, connected with Chris and started helping him manage assets for his portfolio. And then most recently launched this newest fund. So the reason behind it was really as we were kind of managing investor capital and realizing who we were working with, there was really a demand for people to have access to a non-accredited, to an option that didn't require accreditation and didn't have such a high barrier to entry. So even if someone was accredited, diversifying outside of your, stocks, bonds, mutual funds might be, a little intimidating at first. So some of these funds, again, even if accredited, throwing down 50, 100K for your first investment is quite a bit. So this allowed us, going the Reg A route, to open it up to a wider audience and really allow everyone to get in the game and participate in some sort of alternative investment. So, which led us to kind of our mission around democratizing investment opportunities while providing win-win solutions to our borrowers. So some of the terms of our offering, you'll see we have a Reg A plus offering. So that just means it's been qualified by the SEC to accept funds from both accredited and non-accredited investors. The term is 4 years. So the lockup period, as some might call it, is 4 years. And minimum investment, again, sticking in line with not everyone has 25, 50, or wants to start their first investment maybe with that much down. Is our minimum investment is 5,000, and we do start offering bonus shares at 25,000. Then return a preferred dividend anywhere of 8 to 10%. Again, those bonus shares are really what increase that return, and I'll kind of dive into that here shortly. So the bonus shares, again, starting at 25,000, essentially what we are doing, because when you're investing, you're receiving shares. So at 25,000, we are giving you an additional 100 bonus shares. Again, this scales up, so you can see it's 4%. So if you're investing 30, you'll get more than 100. So just keep that in mind as I go through these tiers. So for example, if you were to invest $25,000, we would actually be awarding you an additional 100 bonus shares. Those shares are valued at $10 a share, which means you're getting an additional $1,000 towards your investment that you will both accrue 8% on and be able to liquidate for the cash value of $1,000 at the end of the term, that 4 years. So as you can see, we have different thresholds here. We have 25, 50, 100, and 250, and the percentage of bonus shares awarded increases at each of those tiers. So some offering highlights. So we do accept qualified and non-qualified accounts. So we're very familiar with working with self-directed IRA custodians, IRA Financial, UDirect, Quest, Equity, American IRA. We've worked with them countless times, and we have many investors who do invest via their self-directed IRA. The dividends are paid monthly. So, for example, investors who invest this month, their shares are issued July 1st, and their first dividend payment would be August 1st. So we are raising capital and deploying capital. It is a non-correlated asset class. So we're not, correlated to the ups and downs of the stock market. We are investing in essentially paper-backed by real estate with significant, collateral coverage. So, our LTV on our current portfolio right now is around 30%. So, even in the case of some sort of housing crash where prices decrease, we would still have, I guess anything is possible, Armageddon is possible, but we have ample equity coverage. It is also not a blind pool. So when you're investing, we're not raising capital and waiting for a certain amount to deploy it. Like I mentioned, we currently have an active portfolio, and we are raising capital and deploying it as well on an ongoing basis. We have no management fees, acquisition fees. Essentially, we win when our investors win. So our money is made on the upside of what our investors make. And then for tax purposes, and this is something that I feel like is very often overlooked, but is something you should take into account, I believe, when you're looking at overall return, because it does affect that, this is a 1099 dividend. So no K1s. It is considered a qualified dividend, and that would be taxed as long-term capital gains. Again, not a tax person, so every person's situation is unique, so please consult your CPA. Let's keep going to the next one. And like I mentioned before, this is not our first rodeo. We've done this fix and flip model over 600 times. We've managed 5 full cycle funds in the past that have, exceeded investor expectations, not missed a dividend or distribution. And then we do have a vertically integrated team. And I think this is something that's often overlooked. So, a lot of people will outsource their asset management or their investor relations. This is all for us done in-house. Our team, if you're an investor, you're going to speak with Katie or Tony. And then on the asset management side, it allows us to move through the fix and flip part or the fix, I guess you could say, part of the process quicker, because we are not outsourcing and waiting on someone else to make those decisions or evaluate the situation. So now we're going to talk about the market, what mortgage notes are, and kind of cover a little bit more of that equity piece a little bit, because when it comes from a risk perspective, the equity aspect of it is really something that you should take into account.
So,
Go ahead, Chris.
Thanks. Feels like I haven't spoken for a little
I
while.
know.
So, many people ask, what is mortgage note investing? And for those who have ever purchased a home, typically you would get financing on that. And when you're signing at that closing office, that big, thick bundle of paperwork, the two major components that are in there is one called a mortgage and the other is called the note. And the note is strictly just an IOU that is, you're going to repay this money on specific terms. And the mortgage is really a collateral that says, if you don't pay, then we have the right to secure that real estate behind it. And after you close, many of us will get a letter in the mail that says, please make your payments now to XYZ lender. Well, when that happens, your mortgage actually was just sold. Now, we're slightly different in that we like to target non-performing loans and buy those from hedge funds, private lenders, banks, and we'll talk later why banks sell, because that's a common question we have. And we target to buy that at a discount. And by buying it at a discount, it gives us more flexibility and options to work with the borrower while we're still owed the full amount that's due still on that loan. Lauren?
Yep.
And as we mentioned, there's typically two primary types when we look at mortgages, and we typically like to invest in first position mortgages. And there's the performing and non-performing, which are really self-explanatory. Performing means the borrower is meeting their debt obligation. Non-performing means they're not. And we typically can buy both at a discount to target a yield. The interesting thing about the non-performing loans is many people think, oh my God, I missed a mortgage payment. Somebody's going to come knock on my door and I'm going to get thrown out, foreclosed, evicted. There is a foreclosure process. And the average loan that we see from banks is typically around 2 years behind in payments. So the banks have had these loans on their books for a period of time that, again, on average, are about 2 years behind on payments.
Yeah, and I think one question that comes up a lot that you might want to talk about is, well, why wouldn't banks just do what you guys do?
We do get that a lot. And if you've ever had to deal with your bank on any type of issue, it can be a little painful of just calling them and getting through that answering service of getting onto the right person. And banks are not structured really to deal with defaulted debt, is what it boils down to. They love giving loans. They love getting paid for those loans, but the moment it goes non-performing or goes outside of their specialty, they struggle. And many instances, it's better off for them to sell the loan and try and deal with it.
Yeah, and then I guess kind of leading into that, talking about like what would incentivize a bank to sell? Like, why would they sell?
Yeah, without going too deep down a rabbit hole, banks, when they loan money, can keep it as an asset and a liability on their books. When it goes into default, it is now more of a liability, which causes them to have to keep more money in reserves. And at the end of the day, for them, again, between what it looks like on their balance sheet and not having the right people to deal with it, it's faster for them to sell it to get that money into a better borrower.
And then, Chris, do you want to talk about kind of the equity coverage and why that's important? And here's an example, I think, that we put together.
Yeah. And a lot of people, first thing when they think about defaulted mortgages, think 2008. And people literally walking up the banks and handing the deed to their property because the property values have dropped so significantly and they're underwater because they took out 80/20 loans. And why are you buying defaulted loans? compete with, no, in this marketplace. And for us, we strategically look at loans that have equity. So in the example that you can see on your screen, a property might have a $250,000 value, but only a $100,000 balance. And the way we get to those numbers is many of the loans we buy are 5, 10, 15 years old. So we're typically not buying loans that are currently being originated. We're buying loans that property has appreciated over time, borrowers have paid it down. And as we mentioned, we like to buy at a discount. In this instance, we put a 50% discount. So that $250,000 loan, I'm sorry, $250,000 property might only have a $100,000 loan, and we're purchasing it for $50,000. So at the end of the day, there's a 20% loan to value. Well, Lauren mentioned earlier, if home prices start to soften, you can see that even if they went down by 20%, 50%, there's still equity coverage. And that's one of the things we like to focus on as part of our portfolio. And we'll talk a little bit more about later.
So we're gonna really talk now about like that fix and flip process I mentioned earlier and how we make money in note investing. So essentially Seveney is buying loans. This is the purchase, I guess, buying essentially loans on single family homes at a discount. So again, anywhere from 40 to 60% market value. And then from there, it really goes down to paths to get to that fix and then flip, eventual flip. 90% of the portfolio will fall in this bucket up here. Wow. In this bucket up here, where we negotiate a payment schedule with the borrower. And how that works is for all assets, once they're boarded, we will send a demand letter. Now, a demand letter is the first step in the foreclosure process. And even if our intent is not to foreclose, a demand letter typically brings the borrowers to the table that are willing to work with us. So for about 90% of the portfolio, negotiating that payment schedule with the borrower. And a lot of this goes into the due diligence to make sure that we're boarding the right loans where there is an ability and a desire to get back on track. So doing some sort of trial payment plan with them for 6 months to then essentially, and if they complete that, meaning make 6 months of consecutive payments towards their monthly payment, then we can extend the term. They can make quarterly payments towards the past due. All the while we're generating profits from those payments, and then we can classify the loan after anywhere from 18 to 24 months as reperforming and sell it as a performing asset back on the secondary market. Or in that time period, the borrower might sell the property or refinance. So again, at that top is about 90%. Then there's the 10% that fall into this category where they either can't or refuse to work with us. So we continue with the foreclosure process, and it will go to auction, where we will generate profits from the sale at auction. Now, that doesn't necessarily mean we are taking properties back. That's actually not what we like to do. Typically, these are purchased at auction and we are paid off in full, meaning even if we purchase that, say, $100,000 loan for $50,000, we're still getting that $100,000 plus any recoverable legal fees we put into it throughout the foreclosure process. So that is an example of how we make money on both aspects of the flip. Go ahead, Chris, if you want to take this one.
Yep. So why invest? And talk about our disciplined approach that we have. As we mentioned, we'll purchase the notes at a discount and also be very selective. And the reason we can be selective is when you look at the overall mortgage market, it's a $16 trillion industry. And as part of that, there's roughly any point in time, 250 to 500 billion with a B dollars of delinquent mortgages. And ironically today, because of COVID, we're at all-time highs, and we're starting to see an increase in inventory that I'll let Lauren talk about a little bit in a minute about how the inventory comes through our portfolio. And because we can be selective, it allows us to also diversify and be in different markets. And as I mentioned on one of the earlier slides, if you haven't noticed, we've been in over 40 states. Now there's certain states that we would avoid more than others, such as New York, Alaska, Hawaii, the Pacific Northwest, and parts of the Northeast. And that is because the foreclosure laws in those areas are a little more challenging. But also going back to that 16 trillion again, in the size of our offering, when the money comes in the door, we invest it pretty quickly, but also can cherry pick those assets because we're seeing so much portfolio or tapes, which are really just glorified Excel spreadsheets. And then after that acquisition, one of the things that definitely differentiates us that Lauren mentioned earlier on is how we're vertically integrated and how we have an in-house team who works with the servicer, who work one-on-one with the borrowers to keep them on track or to work out trial payment plans or loan mods. And back to one of the questions of, well, why don't banks do this? You know, banks have a lot of red tape and they have to get many different approvals from people. With us, we have a investment committee team that already knows up front what we'll accept and what we need on that loan. So we can make decisions literally while on the phone with the servicer, communicating to borrower, and once in a while, even that borrower may be on the phone with the servicer. So it allows us the speed to work with these borrowers, which is in their best benefit because sometimes they want to make payments, but the bank won't take it. So it keeps stumbling on. Lauren, you want to add anything?
No, but we did get a question about how do you guarantee the investors will recover the initial capital? So first thing, I will never, and Chris will never, and never, no one should ever say the word guarantee because there is no guarantee when it comes to any investment. So you always want to look at what it's secured by. In this case, the notes, the portfolio of notes that you'd be investing in are secured by single family homes. So let's say worst case, none of the borrowers decide to pay, we would go through foreclosure on all those properties. And that's how we would flip the properties essentially. Again, because we're buying them at a discount. So we're taking 100K note, buying it say at 60K, and it's still worth 100. So if we went all the way through the foreclosure process, we would make that 40,000 on that. Plus again, any recoverable legal expenses that we had put into it going that way. So, yep.
I think the next slide too will kind of highlight some of the aspects of our mortgage note fund that differentiates from other types of funds.
Yeah. So, Chris, do you want to go through this slide?
Yeah. So kind of like you mentioned, Lauren, nobody should ever guarantee any type of investment. And when we talk about our mortgage note fund, some of the things we look at is for investors, it's passive. You're investing in a company where you're owning stock in a company that owns a portfolio, not one asset, but just under 100 assets roughly in our portfolio today. The varying conditions and profitability, as Lauren mentioned, we're not correlated to the stock market. We're not correlated to oil and gas. You know, correlation really is maybe to the job market where less, higher unemployment sees higher NPLs. But because we're buying the way we buy our loans with that equity, we try and create a non-correlating condition. And as Lauren mentioned, we're backed by that collateral and the equity coverage. So it's not unsecured loans that we have. It's not auto debt or credit card debt. It's backed by physical real estate. At every asset we buy, we have somebody or multiple people go take a look at that property, take pictures on. We run title. We do a thorough due diligence. And then the last is, again, that versatility and diversification. We have numerous exit strategies within our loan. And with it not being a single asset, you don't have to wait for that one asset in a 4-year time period, sell, which could take another 2 or 3 years. We have a portfolio of loans that we're constantly buying and selling.
So mortgage note investing as an income strategy. So, a lot of people are trying to figure out stock market, self-storage, oil and gas, like Chris just mentioned, syndication, short-term. And this is where I was, definitely. And so if this sounds like you're looking to, with our investor base, a lot of things we hear, and, if you're someone who's spoken with Katie or Tony, a lot of the things they're hearing are people are looking to either subsidize their current lifestyle or plan for retirement. So, again, planning for retirement, or we have a lot of investors now who are subsidizing car payments, credit card payments, mortgages, daycare. college tuition, whatever that might be. If you're someone who's looking for alternative investments outside the stock market, you know, something that is not correlated to the ups and downs and isn't as volatile. You might be someone who's interested in investing in real estate, but either don't have the time, maybe you have a W-2 job, or maybe and don't have the bandwidth, or maybe you just don't know where to start and are overwhelmed by the options. So instead of doing your due diligence and kind of taking that on, you're doing your due diligence on the sponsor and the fund. And then you might not want to deal with tenants, termites, or toilets. So this is a passive play where you are investing in the fund and receiving the dividends. So I want to walk through, or we want to walk through some case studies to show you, or a case study to show you kind of what this looks like. And I think the case study we chose is actually a good example of banks and how they operate and why they don't necessarily do this, or maybe they could, but are really bad at it.
So this was an asset out in Denver, Colorado. And as part of we bought about 15, 20 loans as part of a quote pool of assets, which is just multiple assets from this one seller, which was, as Lauren mentioned, a bank. And in this asset, you can see, again, we target that equity, $400,000 property. They owe a little over 150, and we buy it at a discount of 100,000. And the borrower was behind, just under $25,000. And we get it under agreement and start reviewing the collateral file, which is really servicing notes, which is like the diary. So the servicers all have to keep a journal or a diary of all the conversations. And we get to see that to do our due diligence. And as part of this, we noticed the seller was doing very minimal effort in trying to work with the borrowers. And it was a smaller lender, so probably they didn't have the staff. So they did have an attorney draft a demand letter, but after that, nothing happened. It just sat there for 9 months. And then the lender decided, oh, well, maybe we want to work with this borrower. So we'll send them what's called a mitigation package, which is really just another loan application to reclassify or get another approval for this borrower to see what they can afford. The borrower actually had responded and offered some type of plan to the lender. But the lender just ignored it. And as part of this was prior to us buying it in May, but when we bought it in May of a year ago, the borrower was offering money down and making extra payments. So once we got under agreement, we sent a demand, and then the borrower stepped up to the table with the servicer, and we restructured, or basically did the deal that the prior lender could have done a year ago. So what we did is we had the borrower sign what's called a trial payment plan, which what I like to call is a payment plan on training wheels, of making sure that if they say they can afford a specific payment, give them a 3 to 6 month period to prove they can do that. And then once they do that, we will then modify that loan, and we'll recast the past due and some of the other amounts into a new balance, and continue the loan from there. So during this time, we would get the payments. If you go back to, if you can think in your head, that top chart that Lauren had of work with the borrower, get the payments coming in as revenue, and then that this is a performing loan, to turn around and sell back on that secondary market for higher value than the discount that we provided, to give us that extra bump in the earnings. Anything else you want to add, Lauren?
No. Just there you go.
One thing I did want to add, because I saw a question pop up, in between, and you may have mentioned this, but I just want to reiterate it too, is people are buying shares in the offering and they're in an equity position, but we have no debt. So I just want to mention that. I think you mentioned it earlier, but there is no debt. So in this offering, so right now, if you understand capital stack, the investors are at the bottom or the lowest tier in the capital stack currently, which is as an investor, again, people can form their own opinions, but you're in front of everybody else.
Yeah. So if we want to walk through worst case scenario, people always want to know if things were to go bad. It's like, I probably can't say these words on on a Zoom. If things were to go completely south, and we had to say file for bankruptcy, we would have if you know how bankruptcy works, you have to pay all your outstanding debtors out, and then like operating expenses. We don't have any additional debt. That's why that's important. So we wouldn't have a line of credit or, a loan to pay before investors get paid. It would be liquidating the assets and investors being paid. So just kind of wanted to give an example to that since we got that question, and I'm not going to ignore it. So one thing, getting to know us, if you're either from Investor or you saw this, I don't know how you got to the webinar, maybe you've been on our newsletter. If you are not, join our newsletter. We do provide deals of the week every week, so you can see kind of what this looks like in practice. Reach out to our team, schedule a call, get your questions answered. You can go to invest@seveneyinvestments.com, or you can go to our website, seveneyinvestments.com, and actually book a call directly from there, or chat with a member of our team, whatever you prefer. And I don't see any other questions. Usually there's more questions. I don't know if that's a good thing or a bad thing, but if anyone has any additional questions, feel free to drop them in the chat. I'll hang out here a little bit more and keep answering some more FAQs. And if not, then we'll let you guys go. We try to keep these webinars. Oh, one thing I do want to say is these webinars, are for you. So if there is anything that you want to hear more about or less about, or feedback, comments, concerns, questions, feel free to, again, email invest@seveneyinvestments with your thoughts, and we will take them into consideration as we plan out the upcoming webinars. Yes, so we do also sell individual notes. So if that is something you are interested in, feel free to email invest@seveneyinvestments, and we will get you connected with the right person.
Actually, they should reach out to asset sales at Seveney Investments. They don't need to blow up the invest box. They can also send it to asset sales at Seveney Investments.
Any other questions? Well, thank you guys so much for joining us today. If you have any other questions, or I hope you found this helpful. Oh, we did get another question. Derek, I will, someone just asked, what does my return look like if I invest $100,000? So if you book a call with a member of our team, I'll have someone reach out to you, Derek. But if that's a question you have on the calls that you do schedule with our team, we can, follow up with you and provide what a breakdown would look like. Again, this is a breakdown of what it could look like. I have to say could, because again, nothing is guaranteed. But if you speak with a member of our team and want them to run a few scenarios, then they can follow up with you via email. So Derek, I would reach out to Invest@Seveney Investments, and they can kind of walk you through that. So, okay. Well, thank you guys again so much for joining us. Let me know if you have any questions. Again, feel free to book a call, reach out, join our deal of the week, and have a great day, everybody.
Thank you. Take care.
Bye.